So over the last couple of months, global fixed income markets have been absolutely fascinating. If we go back to May, we saw a dramatic rise in trade-related tensions, and as a result, global fixed income markets actually started to price in concerns around global growth. Looking at the negative yielding global aggregate debt, that spiked from about $10 trillion in May to a high of $17 trillion in August, as investors sought safe havens. Also, what we saw in May was an inversion of the US yield curve. Looking at the 3-month yields versus 10-year yields, those actually moved negative. And this is a measure that people look at very, very closely because since World War II, an inversion of this yield curve has predated every single recession with no false positives. What we then finally saw in September, midway through September, we saw the Fed lose control of the repo rate, with overnight yields spiking up to 10%. Local fixed income markets, in comparison to their global peers, have actually been relatively benign. Over the last 12 months, we've seen a nice compression across our yield curve, but a lot of that happened up until July, and we've seen a retracement since then. On the inflation-linked bonds, conversely, we've actually seen a steady upward move on those yields across the curve over the year. If we have a look at the non-sovereign part of the curve, we've seen a lot of risk aversion in South Africa, and as a result, we've seen significant flows into lower risk funds. And this has driven significant demand for NCDs and for credit instruments. And as a result, NCD yields and credit yields have compressed quite significantly over the year. So for example, we've seen the 5-year NCDs move from a peak of 9.5% down to a current level of 8.1%. Looking at the shorter end of the curve, we saw the Reserve Bank cut rates 25 basis points in July, and the markets are currently pricing in a further 25 basis point cut over the next 3 months, and possibly even a further cut early next year. So with inflation in South Africa seemingly anchored around 4.5%, our nominal bonds are actually offering some of the best real yields on a risk-adjusted basis globally. If we have a look on the inflation-linked bond side of things, those are not only offering very good real yields, but also offer a level of inflation protection. And across both of those curves, given the steepness of the curve, we are actually seeing the best opportunities on the longer-dated bonds. So as I mentioned earlier, we've seen a significant compression based on flows and demand on credit instruments, and a number of these credits are now trading below where we as PSG Asset Management see value. As a result, we have been selling those credit instruments where appropriate, and in terms of adding new instruments into the portfolio, we've been very, very selective on those. Similar to what we see in South Africa, globally, the search for yield has resulted in credit yields being compressed significantly, and as a result, there's significant concern in that area of the market as well.